Hello and welcome back. Today we'll be taking a look at one of the methods of valuing a company stock, which is under the intrinsic valuation. During the last video, we explained the differences between intrinsic valuation and relative valuation. I'm going to leave the video right here. So DDM, which is also called dividend discount model, is under the intrinsic valuation methodology, which we use to value a stock. But what we're going to be focusing on for today's class is basically when we have scenarios of multi-stage dividend. What do we mean by multi-stage? Or any business, you need to understand the life cycle of a business. When a business starts initially, there's going to be some sort of the rate at which the company is growing is going to be fast because of the exposure it's just having to the market. But it's going to get to a certain period of time where the growth rate is going to start slowing down, meaning the country has reached a growth stage of the business, basically. So the G, which is growth rate, is now going to slow down. So if you look at the life cycle stage or life stages of a business, you see that we are from the introduction stage down to the decline stage. Now, when the business is at a growth rate, like between the introduction stage and the growth stage, the rate at which the company is going to be growing is going to be at a higher growth rate. But when the company actually gets to that maturity stage, the company is now matured. It's going to be growing, but the rate at which it's going to be growing is not going to be the same as which it is going to be growing at the initial stage the company was before. Now, so dividend discount model is just trying to factor those two scenarios. When the company is between the introduction stage and when it is at the growth stage, and also we'll look at it relative to when it is now a matured company. Yeah. So because that growth rate between the introduction stage and the growth stage is not going to be forever. It's going to slow down when it gets to a certain period of time. So that is what multi-stage dividend growth wants to take into account, basically. So we're going to be looking at a scenario here. So we have two formulas for solving multi-stage dividend growth stage. However, this formula is going to lead to the same answer. It's just the interpretation that actually matters. Yeah. So for one, we have D1, and for this particular formula, then for the other formula, we have D0. So you need to understand the difference between each parameters here. So D0 is basically the current dividend, while D1 is the dividend in which growth has been factored into. Again, so let me just put it this way. D1 is just the dividend that is going to be paid next year, while D0 or DO is the current dividend for the current year, for the current period of time. That is D0. So when you're given a question, you need to understand which dividend are we being given. Are we given the dividend for the current year? Are we giving projected dividend, which is for next year? So which means G already has been factored into it. So we look at the parameters one by one. We have PO, which is basically we are trying to get the intrinsic value of the stock or of the share price, which is also referred to as the fair share price that is noted here. We have D1, like I explained earlier, and we have D0. Also, we have G1, which is basically the dividend growth rate that was given during stage 1, like I explained earlier. Then we have G2, which is dividend given during stage 2. Then we have KE, which is going to be our cost of equity or our required rate of return. Let me digress a bit. Now, DDM is relating to just equity holders. Remember, when you look at the capital structure of a firm, you have debt, you have equity. So the equity side is dividend. Remember, equity holders get dividend at the end of the period, while debt holders get interest at the end of the period. So when you want to discount what equity holders are getting alone, you use cost of equity. But when you want to get what all of them are getting together, like both debt holders and equity holders, you use weighted average cost of capital. Just additional knowledge. Now, like I was saying, KE is our required rate of return, which is also our cost of equity. Then we have N, which is number of years in stage 1. Same thing applies to second formula also. Just the difference between those two is just scenarios when you're giving DO and scenarios when you're giving D1. Also recall that your DO, sorry about that. Recall that your DO or your D1 rather, your D1 is the same thing as your D0, 1 plus G. The same thing as your D0, 1 plus G. So this is this same thing as your G1, 1 plus G. Now, from the question we have, let's just take a quick question. So the video will not be too long. So from the question we have, let me cut this so we can zoom in properly. So we're trying to calculate the fair price or the intrinsic price of a company that pays a dividend of $3 per share, whose annual dividend are expected to grow at 25%. Expected to grow at 25%. So for the next 5 years, basically, so let's pick one by one. We have the first parameter here, dividend per share, expected to grow by 25% for the next 5 years. So, okay, let's continue before we come back to them. And it's going to slow down to 5% growth after that. So after the first period, this is the second period, basically. So we know that this 25% is basically our G1, which is given, our G1. Then it's going to slow down to 5% after the first 5 years. This is going to be the growth for the second period, which is now going to be our G2. So we're told to assume the required rate of return, which is also the same thing as our um, cost of equity, or KE. We're told to assume it to be 9%. So from the question, let me put, okay, yeah, we will need to come back though. Let's come back. So let's look at the dividend because the formulas are the same thing like I explained earlier. The dividend given, we need to determine is it current dividend or is it projected dividend. So let's go that again. So is a dividend of $30 per share, $30 per share, whose annual dividend are expected to grow by 25%. From the question, we can actually deduce that this is current dividend. This is current dividend, yeah, for the what's it called, for the period. For the period. So we're going to plug that into our formula. We're going to plug that into our formula. If you want to use the first one, which is D1, so you need to actually get D1 using D notes because we were given D notes. So you do 1 plus D naught 1 plus G. Do D naught 1 plus G if you want to use this particular formula. However, because you have D naught given directly, so we are going to be sticking with the second formula. So I'm just going to pull this up. Just give me a minute to pull this up. Let me erase that. Yeah, let me put that up. So let me adjust this a bit so we can actually see. So let me pull that up again. So we have this. I'm going to be pressing it directly on our calculator. Though I'm going to do it side by side. So I will take these as the first side. This particular formula should be A. Then this one is going to be the B aspect. Then at the end of the day, we add both of them together. So I'm coming here. Press calculator. You know how to press calculator. So our denotes on the question is basically 3. That's 3. So into bracket 1 plus what's our G1 from the question? That is 25%, which is the same thing as 0.25. Close the bracket. Then we go down. What's our K? Our required rate of return, we have 9%, 0.009 rather, minus our G1, which is our growth, 0.25. So we'll move on. Then multiply by into brackets 1 minus, according to the formula, we have under bracket. Then we have this. So we have 1 plus the G1, which is 0.25. Go down 1 plus our required rate of return, which is 0.09. Then everything is going to be raised power in the number of years. So from the number of years we have, which is number of years in stage 1, we have 5 years. We have this is here, we have 5 years. We have 5 years. So I'm just going to come down there, put in 5 at the top, then just close the brackets here. Sorry, close the bracket there. So we have a question. So the first thing we have there was 23.049. 23.049. Let me write that out. Equals to 23.049 plus. So we need to do the second side. So I'm just going to see this. So we'll come here, same thing. Also our D naught. Our D naught is 3. Into brackets 1 plus G. 1 plus G. Our G1, in this case, 0.25. Then raised power number of years, which is 5, from what we said earlier. Then into brackets 1 plus. Now we need G2, which is our growth rate for the second period. We are doing a two-phase model. Yeah. So we've done the first phase. There's the second phase, which is our G2. So the second phase is basically 5%, which is 0.05. Then we need to close that bracket, go down. And denominator, yes. KE, which is our required rate of return, is 0.09 minus our G2 growth rate, 0.05 into brackets. Then we have 1 plus KE. 1 plus KE, which is 0.09. Everything raised by the number of years, which is 5. So I'm going to have enter there. We have 156.195. So because we have this one in 3 decimal place, so I'm just going to stick with 3 decimal place there. So 156.195. So just come down here back. 156.195. 156.195. Let me zoom in a bit so we can see. So we have this here. Of this. So at the end of the day, we are going to add this together. It's going to give us our intrinsic valuation, our intrinsic price rather, for the stock. So we have 23.049 to be added to 156.195, and then we have enter. So I'm just going to click on the SD to have. So at the end of the day, we arrive at 179.244. So at the end of the day, we have our fair value of the share price to be $179.244 basically. So this is how to use your multi-stage model rather to get your fair share price. Now there are other methods apart from this in which you can actually get your fair share price, but that's a bit cumbersome. Yeah, it's going to be a bit cumbersome, in which you need to get D1, D2, D3, D4, and D5. You then project that, you grow that. Sorry about that. Yeah, so you need to get D1, D2, D3, meaning the answer you get here, D0 plus 1G. Let's say we have 45. When you get to D2, so it's going to be your D2 is now going to be your D1, 1 plus G1. So your D3 also is going to be your D2, 1 plus G1. Your D4, like that. So when you get the answers like this, you are going to present value them. Yes, you present value them using the KE, the required rate of return. By the end of the day, when you do that, you need to actually get the terminal value also. When you get the terminal value, then you add both of them together. That's another method to do it. But the formulas we have here is pretty straightforward in order to get fair share price. Thank you. That will be all for this video. If you have any question, I'll be in the comment section to reply to any of them. Thank you very much and good luck.